Alright, we're going. This is it. Should I make funny faces at the camera? Alright, everybody listen up. We're on tape now. Maybe we'll be up for a People's Choice Award or something. We'll see. Alright, here's Kroger. I'm just going to go through this quickly. It'll probably take me about 30 minutes to go through the whole thing. So here's Kroger. You can see their revenue growth. See their income decline. Your times interest earned, all these items that we need. So let's say I'm doing the exam, and hopefully so everybody has access to see. If not, just look on the screen. So in this paper, I am going to do a financial assessment of Kroger's. First, assessing their short-term viability by looking at liquidity and solvency. Then I will look at their long-term growth prospects by considering turnover and margin. So excuse the typos. I don't think prospects has a 3 in it. So, all right. First, looking at Kroger's liquidity, I would like to make the following points. Why they do that, but all right. So number one, I'm going to look at growth in cash from operations. So when we look at Kroger's, we see that their cash from operations has grown at a measly 2.5%. CFO has only grown, I'm using the CAGR, at about 2.5 from what years do we have? From 2006 through 2011. This is not strong growth and probably only about in line with inflation. Looking at CFO growth versus growth in EBIT, and we'll go into the data and we'll look at the graphs on the second page. And here we see CFO versus EBIT, graph number 9. We notice something strange is going on. There's something strange going on with EBIT, but fortunately for us, CFO is much stronger than EBIT, and so I'm going to put that into my write-up. We notice in graph 9 that CFO growth is much stronger than EBIT. This certainly raises questions and is probably related to a working capital account. However, it is good that while disconnected, CFO is much stronger than EBIT, meaning I do not see serious issues with quality of earnings. More research is needed to explain this disconnect. Everybody see what I mean by disconnect? They're not They should generally grow together. They don't be exactly on top of each other, but they should generally grow together. What worries me the most, and I might discuss that, is especially '09, the large drop in '09 in EBIT versus no drop in CFO. So I might bring that in and get a few extra points, especially the large drop in 2009 EBIT versus no drop in CFO. So more analysis is done there. Now looking at net working capital requirement. So we'll go look at the net working capital requirement. Their working capital assets have grown 1.7%. Working capital liabilities have grown at 3%. The working capital requirement is a negative number, so it's a use. I mean, it's a source, excuse me, it's a source. And it's growing quite dramatically. There's definitely some disconnect going on between the growth of assets and liabilities. That's where more research is needed. So we see that it is a source of cash. Working capital assets are less than working capital liabilities. And this source is growing very strongly. CAGR, what did we say, 43% or something? 43%. This is a very strong indication that liquidity is not a concern for this company. So we still need to research why working capital assets are growing much more slowly than working capital liabilities. So you see how I said more research. So you put it in there. Now on this particular one, I could do more research because I have the detail there on the Bloomberg page. But on the exam, you don't have that Bloomberg page. All you have is the handouts we have there. I know y'all are trying to write all this down. I'm going to put this out on Blackboard when I'm typing here, so you'll have it. So if you're trying to frantically keep up with me, I'm not going to delete this file. All right. And then the last thing. Next, looking at cash flows with stockholders and lenders. What do we see there? We come up here and see that their dividends have been growing a very good clip at 13%. Their stock buybacks, look at that, very, very strong, especially in 2011, 1.4 billion. They did borrow a little bit of money in 2011, but still, look at that net, very healthy. They're sending a lot of cash to their stockholders and bondholders. So 12% CAGR. We see a large and growing 12% CAGR cash flow to stockholders, particularly, and bondholders. So they did borrow some in 2011. This reflects what I believe to be strong evidence of good liquidity as it reflects management's confidence. Boy, it's pretty badly worded there, typed there. For some reason, Bill Gates doesn't know cash flow is a word, but I think it is. So we're going to leave it. We're going to leave it like that. All right. Have I covered liquidity? There's 4 things in liquidity. All right. So, second, let's look at Kroger's solvency. Whoa.
You don't need us to go like over other uses of cash?
Don't need a what?
Other uses of cash, like the 15?
Well, other uses of cash, you could talk about that if you had more information. We don't really have much information. We have their cash from operations. We have what they're sending in cash to their stockholders and bondholders. We have the cash impact of capital assets and cash, net working capital assets and liabilities. Other source, other uses of cash is something if we had more data, but on this particular one, I haven't really given you much more to work with. So that's about all you have is those 4 items. For your project 1, you can certainly talk other things along that line if you'd like to. All right, let's look at solvency and say first, Kroger's times interest earned. Let's look at that, times interest earned. That looks like it could be an issue. Remember, I said 2 is where you're starting to get dangerous, and their times interest earned is down to 2.93. I think a lot of it's because their earnings are down a lot. Their interest expense hasn't really changed all that much, but their earnings are down a bunch. So this is more a reflection of less earnings. But that means they're less able to pay their bondholders because they're not earning as much. So their times interest earned is a concern as it approaches the 2.0 level. It was... Your sneeze is going to be on the video now. No, that's good. That shows that there's a live audience. All right, it's 2.93 versus it was as high as it was 4.77 the year before, but it's versus being well above 4.5. We need to watch this, especially given the increased debt in 2011. Growth in debt, we'll look at that. So here's their total debt. Growth in debt has grown 2.95%. Does not look like a serious problem, but with the large payments to stockholders and the declining earnings, their ability to pay debt is declining at an alarming rate. So debt isn't growing all that fast, but given other things going on with the firm, they're paying their stockholders a lot of money, so that means their equity is coming down. They're still issuing debt in 2011, even though they're paying their stockholders a lot. And so what does that mean? Well, let's look at debt to equity. Debt to equity has grown quite dramatically. Debt to equity has grown from 1.4 to 2.06. So they have $2 in debt for every $1 in equity, so 143 to 2.06. So debt to equity as a result has jumped to, I've already forgotten the numbers, so what I say, 2.06 from 1.43 in the previous years. In fact, I should state that a little bit better. $1.43 in 2006. I'll say specifically. This trend in debt to equity needs to be watched to see if it levels off around 2 and starts declining. I would want to hear what management has to say about this. So again, more research is needed. What is management going to say about this? So it's good that they're not growing their debt really quickly, but their capacity to pay debt, when we look at debt versus equity, or look at their debt versus their interest expense versus their earnings, it looks like their ability to pay the debt is definitely declining. So debt's not growing fast, but the other things that are supporting debt are declining, and that's an issue. Finally, looking at combined financial leverage, we see, what do we see? We have to go look here. At the very bottom of the page down here, combined financial leverage. We see that it's also increasing at a faster rate than a lot of other things. It's growing, has been growing at a 3% clip. So we see that's growing not as fast as debt to equity maybe. Debt to equity is up quite a bit, about a third, but we see a 3.3% increase. That the financial leverage of the firm is growing faster than the firm and its earnings. This makes sense given that debt is growing, earnings are declining, and management is paying large amounts to stockholders. All right? And that's one that may be tough to get into your paper. There are some of these that are more advanced than others. You don't have to get every single one of them to get a good grade on the exam, but this is a more complex thing. So if we look at this firm, it's somewhat interesting that their shareholders' equity is actually fallen. So even though their debt's only grown about 3%, you notice that their shareholders' equity is falling. Why is it falling? Well, because their earnings are falling, and they're paying out all of this money. If we add up all of this money, they paid out $5.6 billion in dividends and stock buybacks to their stockholders. All of that comes right out of net worth, and so their net worth is coming down. So it certainly adds issue. Why are you increasing your dividends 13% if your earnings are down 11%? That certainly raises some issues. So this firm, while its debt doesn't look completely out of hand, it certainly raises issues. So my summary for short-term viability, I do not see a serious issue for liquidity. However, I believe the firm has an issue with its financial leverage. Now, one thing I forgot to do, and I'll go back and do it at number 2, is we might say, well, is this really serious? Let's look at a competitor. Remember, you always, if you have a chance to look at a competitor, look at a competitor. Let's see if there's anything up here I can look at with a competitor. The combined financial leverage, we look at Safeway versus Kroger. We'll notice, other than that blip with Safeway, we'll notice that Kroger is well above Safeway. So we'll add that into my last point here. Looking at graph, and I've already forgotten which graph it is. I try to number these so you can talk that. Graph 5, we see that Kroger's combined financial leverage is consistently above its competitor, Safeway, providing further evidence Kroger's debt needs to come down. And I'll do the same thing with debt to equity. So I'll look back at the charts. Debt to equity, slide 6, the same thing. Graph 6 shows Kroger's debt to equity consistently above its competitor, Safeway. So I believe Kroger's debt level to be an issue. Right? So I've pretty much summarized that liquidity is not a problem, financial leverage is a problem, and I can say as its growth and level versus a key competitor are both issues to watch. All right, so I have a negative and a positive. Strong liquidity, because net working capital is a source. That's always good, and it's growing really, really strong, so they've got great cash flow. But when it comes to earnings and comes to debt and equity, they've got an issue. All right, y'all can ask questions once we turn the video off, unless you have one where you think I really said something that needs to be clarified. All right, now let's turn our attention to long-term prospects for growth. By first looking at turnover. All right, with turnover, first, Kroger's top line growth, that's revenue growth. So let's go look at that. Their top line growth, well, top line growth will be the top line. Looks pretty strong. Their revenue growth the last several years has a CAGR of 6.45%. You notice I don't give the years again. Once I give the years the first time, I'm like, you know, the CAGR is off of 2006 through 2011, so I'll just say it once. And after that, I can just say CAGR. So you can use some shortcuts. So it's a CAGR of 6.45%, which looks very healthy and above inflation. So Kroger is getting good revenue growth. But secondly, I want to say, what is the source of this growth? Higher turnover or increased capacity? So I'm going to ask that question. So we'll go back and look. Y'all remember how we do that? We come down here and we say, okay, revenues grow 6.45%, but where did it come from? Well, we added 5.43% in square foot. The actual growth per square foot was only 1%. So 5.4% came from revenue, from new square foot. 1% came from revenue per square foot. I'm sorry, I said that backwards, didn't I? All right, let's look at that. So this is actually pretty good, isn't it? I said it backwards. They only grew the capacity 1%. Sorry. They grew their square feet by 1%. They actually reduced the number of stores, but the revenue per square foot was at 5.4. That's very, very good. This looks very good for Kroger's, as their revenue per square foot rose a very healthy 5.43%. If anytime you're doing a CAGR, you need to say it's a CAGR, okay? If you say something grew at a certain amount, people don't know if that means, you know, from point to point or on annual average. So say that. Well, capacity, added square feet, at a CAGR of just under 1%. And number of stores has actually declined slightly the past few years. Kroger's is doing a good job of getting more store traffic. That's very good. That's really, really, really strong. their ATO, their asset turnover, we'll look at that. Their asset turnover is right there. It's a 3.85, has been growing strong. Uh-oh, where are we here? And versus their competitor. Let's look at that and see how they've done versus their competitor. Graph 1 shows much, much stronger than their competitor. I mean, it's not even close, is it? Kroger definitely outshines. ATO is a definite strength for Kroger's. All right. Now let's look at margins, considering following. All right, the first thing I want to do, first looking at gross margins. Let's look at their gross margins to see how those have done. See if there's a gross margin chart. I didn't give you a gross margin chart, so we can't compare to competitors here. But here's a gross margin. Look at it over time. What do you notice? Definitely declining over time. Doesn't look too good. That's declined from 24% to under 21%. This is a serious issue that needs to be watched. I would want to hear management's strategy to reverse this decline. Wouldn't you? When you want, if you were talking to management and says, "My word, have you noticed your margins have really, your gross margins have come down quite significantly?" They may say, "Well, it's because of a change in business mix. It could be competitive. It could be because of Walmart, you know, what it's doing. You know, there's all kinds of excuses they may have." I want to say, that's great. I love your excuses. Now I want to hear your solution. What are you doing to fix this? All right. Next, looking at the net margin. Here we can compare this to the competitors. So let's look at the net margin itself. Here's the net margin. Wow, look at that. It's declined dramatically. It's actually, look at that CAGR. It's declined from 3.4% to 1.4%. So from 2006 to 2011, a CAGR, what was it? Minus almost 16%. Let's look at it versus our competitor then. Let's see. Now, part of our excuse could be, well, you know what? The whole industry's coming down. Now, we only have one competitor, so we can't say that. But let's see if maybe their competitor has the same issue. So look at the net margin. Wow, Safeway's is much more volatile. It looks like, you know, the 2009 was a recession. You might wonder why a grocery store would be so sensitive to recession. Safeway looks a lot worse. You're seeing a similar decline, but just more pronounced. So we could certainly say that. Looking at Safeway, we see a similar decline, but much less pronounced than Kroger's. So Kroger's appears to be losing some ground here. and is consistently below safe weight. And that's not unusual. It's not unusual for one firm that excel in asset turnover and another one to excel in margin. But in this case, we're looking at the gaps. So, the good thing is they do so extremely well in asset turnover, maybe they can give up on some of margin. But the next thing we need to do is combine these two. So we need to have a conclusion